Ethereum, reclaiming the $4,000 mark for the first time since December 2024, is more than a headline. It's a market event that forces investors to reassess the balance of forces between Bitcoin and altcoins, and to weigh a realistic path to new highs against the ever-present risks that could snuff out the move. The simple facts are striking. Ether printed roughly $4,012 on Friday, a level it hasn't sustainably held in 8 months. And that alone changes the narrative from recovery to reaccumulation in the eyes of many traders. But raw price is only the beginning. What matters is why price is moved, who's participating, and whether the structural conditions can sustain a continued push toward all-time highs. On the bullish side, several technical and on-chain signals line up in a way that supports further upside. Technical analysts point to renewed momentum across multiple timeframes, with price action breaking above recent resistance bands and reclaiming psychological levels that trigger algorithmic buys and institutional re-entries. A number of traders highlight a visible accumulation pattern from large holders and freshly created institutional-sized wallets that have been taking material positions in ETH, suggesting that professional capital is moving in rather than just retail speculation. Overlaying these flows is a shift in market structure. Bitcoin's share of the total crypto capitalization has softened. And as BTC dominance ebbs, capital traditionally rotates into major altcoins and Ethereum as the primary smart contract. Platform and settlement layer for DeFi and tokenization is the natural beneficiary of that rotation. Analysts such as Rect Capital argue that ETH's dominance has recovered a substantial portion of its long-term move, and that price behavior resembles prior cycles where a reaccumulation phase preceded a major leg higher. His commentary has been widely shared and used by traders as a framework for sizing risk-on exposures. The confluence of fresh whale activity, exchange outflows, and positive technical crossovers creates a plausible, even probable, scenario in which ETH pushes further. Spot and derivative liquidity are flowing in. Open interest in ETH futures has ballooned in recent sessions, another sign of renewed institutional engagement. And order books show pockets of support that could be used as launchpads for the next rallies. When institutional flows, retail momentum, and technical confirmation align, markets often accelerate on the upside, and that's the case bulls are making right now. Yet the other side of the ledger is equally real and demands respect first. The move to $4,000 has occurred amid thin pockets of liquidity at certain times and the presence of large latent liquidation clusters. Just below the current price, maps show substantial long liquidation density under roughly $3,960. Inexperienced traders warn that those clusters are exactly what smart money hunts. They create a magnet for price to test and then rip through as shorts cover. But they can also trap longs if the market fails to clear resistance decisively. In plain terms, the same liquidation architecture that can accelerate a rally can also amplify a pullback if sellers take control or if a large stop run occurs. Second, on-chain usage metrics present a mixed picture. While price is rising, certain ratios like NVT network value to transactions indicate that market valuation is outpacing actual on-chain activity in some windows, implying that speculation may be leading fundamentals for now. That's important because rallies that are predominantly speculative tend to be more vulnerable to reversals when macro liquidity tightens or when sentiment shifts. Observers have also flagged that while whales accumulate, some of these flows could be intermediated by OTC desks and prime brokers, meaning the movement into institutional wallets might be preparatory rather than final, and could unwind. If profit objectives change or macro conditions degrade, macro factors loom large over both scenarios. If central banks remain relatively dovish, or if risk appetite broadens due to calming inflation prints, flows into risk asset stocks, crypto could sustain ETH's charge toward new highs. In that environment, Ethereum benefits disproportionately because it's used as collateral settlement layer for DeFi and as the foundation for tokenized financial instruments, all of which appeal to institutional treasuries and trading desks looking for exposure to the next wave of digital native infrastructure. Conversely, any hawkish pivot from major central banks or a shock to global growth expectations could reverse the narrative quickly, sending liquidity out of speculative pockets and forcing leverage positions to unwind, which hits volatile assets like ETH hard. That's why monitoring macro liquidity and pace of rate change signals is not optional. They are among the primary levers that determine whether $4,000 becomes a launch pad or a local top. Sentiment and narrative also play an outsized role. In this cycle, the psychology of market participants has shifted from, "Is the bear market over?" to "Where will the next leg of upside come from?" That's a bullish signal in many respects. As more money managers and allocators adopt a participate but protect stance, flows can be durable. However, narratives can change in a heartbeat. A notable negative catalyst, a hack, a high-profile protocol failure, surprise regulatory action, or sudden large-scale liquidation in a correlated market can flip sentiment. And because momentum traders herd heavily into altcoin breakouts, that flip can produce an outsized down move. The market's reflexivity, where price action influences sentiment, which in turn moves. Price is powerful right now precisely because many participants are waiting on the sidelines with dry powder, ready to either double down or run for the exits depending on the next high-impact signal. Looking at the microstructure, it's also essential to reconcile derivatives positioning with spot behavior. Futures open interest has been elevated, and while that signals engagement, it also implies greater leverage in the system. The presence of high open interest means that a price shock can trigger cascade liquidations on either side, which amplifies volatility. Options markets can add nuance. Heavy put buying at certain strikes represents institutional hedging that can act as a floor, while heavy call writing can suppress upward moves until gamma hedging forces dealers to buy into strength. In recent days, option flows around $4,000 have shown both aggressive buyer interest and significant hedging activity, a classic pattern seen at regime change inflection points. Those dynamics create a narrow path to higher prices. The market must absorb leverage, satisfy hedgers, and attract fresh fundamental flows concurrently. Practical risk management and tactical responses, therefore critical for anyone watching. This move, traders should treat $4,000 as a milestone. It's not a guarantee. It can be used to recalibrate positions, tighten stops, or scale exposure depending on whether follow-through volume confirms the breakout. For investors with a longer time horizon, the path to all-time highs should be evaluated against adoption metrics. Are active addresses increasing? Is DeFi growth on Ethereum meaningful? Are institutional custody solutions and ETF products materially expanding access? If those boxes check, higher prices have a firmer foundation. If not, price becomes more narrative-driven and therefore more fragile. It's worth noting that many successful institutional entrants historically staged buys over weeks or months rather than piling in on single-day breakouts, a point that suggests patient accumulation, rather than aggressive leverage, is the prudent path if you believe in a multi-year bull case for ETH. We also must be honest about the possibility of mean reversion, technical resistance around the $4,100, $4,200 zone has proven stubborn. In the past, and historical patterns suggest that every major breakthrough tests conviction. That's not a reason to be bearish by default, but it is a reason to demand evidence. Rising volume on spot exchanges, net outflows from exchanges into cold storage, persistent decreases in sell-side liquidity, and rising on-chain transaction value would move the needle from possible to probable for a sustained march higher. Conversely, if volume fails to expand and exchange inventories remain steady or increase, then the $4,000 print risks being a liquidity-driven peak that fades on the next wave of profit-taking. Finally, strategic players should watch several key indicators in real time. BTC dominance to judge whether capital rotation continues. ETH futures open interest and funding rates to gauge leverage and directional bias. On-chain flows wallets, exchange inflows, outflows, and smart contract activity. An order book depth at psychological levels to see whether support is genuine or merely superficial. Additionally, regulatory headlines, whether from the US, Europe, or Asia, can turn a technically clean breakout into a policy-driven reversal, and vice versa. The reality is that $4,000 is as much a political and institutional milestone as it is a technical one. Crossing and holding it opens the pathways to new institutional instruments, media narratives, and client allocations. But it also invites scrutiny and profit-taking to sum up, without being simplistic. Ethereum's return to $4,000 marks a pivotal moment where technical momentum, whale and institutional flows, and a shifting dominance landscape are aligning in favor of further upside, but the same configuration also concentrates risks, particularly in liquidity structure, derivatives exposure, and macro regulatory sensitivity.